Welcome to a demonstration of the Moore-Stephens lease transition and calculator tools. We have two models. One is for the transitional period, which should be used once only for your transition from AASB 117 through to the new lease standard AASB 16. Post-transition, in the years after that, you can then use the calculator model for ongoing periods after that transition. This demonstration will show you how to use both models. The cover page has important terms and conditions of the use of the model. Then you should consider the user guide page, which will explain what certain tabs on the model do, as well as listen to this video. The main user inputs are highlighted in the blue worksheet tabs. The first one is the time series. So the time series sets your financial year end. It is created for leases that start no earlier than 2010 and end post 2040. We can make bespoke models. Please contact us if you need periods outside of that. And it's set for a typical transition year end of 2020. So for June year ends, most organisations will transition in the year 2020. However, if you're a December year end, you might be transitioning in 2019, or if you decide to early adopt the standard, you might be transitioning 2019 or 2018, and the model can handle that. So you just need to change the transition year. Then one of the most important inputs is the last historical month. For the model to work efficiently, especially for higher numbers of leases, then you should set this outside of the actual year and in the last month of a financial year. So if we're transitioning here in 2020, the last historical month should be no later than June 2019, which is in your comparative year. But in this instance, because we're transitioning a couple of years, or we're providing entries for the impact of the standard, we might only have 2018 numbers. And as I said, it's important to set that as the last month in whichever year you're looking at. So this one we've set to June 2018, and I'll talk about where that then becomes important. So you set those half a dozen parameters, and then you move on to the lease assumption tabs. Now this demonstration shows a 10 lease model down here, and you can input actual lease names. So you could put registrations on cars, you could include photocopiers or street addresses, etc. for properties. We'll come to the consolidation options at the end once you get an analysis of what the options are, but the standard allows 3 transitional options, and the model can handle all 3 of those options. You then put in the lease start date, the term of the lease, what the payment is. I'll come back to the payment, the monthly payment. It can handle fixed increases. If you have market-based increases or CPI increases, then set that at 0%. You'll then, in the calculator model, you're able to put in actual payments when they change based on CPI indexes or based on market-based accruals. The model assumes that the increase occurs on the annual anniversary date. You can include any fit-out contributions and incentives that were provided. What is the useful life of those incentives? Are there any make goods? A make good should be what you expect to pay at the time you make good. So in other words, the nominal payment at the make good period, which is typically at the end of the lease, rather than what you expect to pay today. You then set the incremental borrowing rates. For most leases that are operating leases, you're not going to be able to calculate an implicit interest rate, so you're going to default to an incremental borrowing rate. Now, these tools are only used for transition and operating leases. It's assumed that you'll continue to use your current software for finance leases. The model can also include rent-free periods, and it assumes that they start at the start. So you put in the months there. And one of the critical inputs is the option period. Please don't put all option periods in here. The standard only requires you to include option periods that you're reasonably certain of using. So if you're reasonably certain that you will use those, put them in, and the model will include them in the calculation. And that's really all that you have to input for each of the leases. As I said, this is a 10 lease model, but we can provide a 50 lease model as well. So you can either purchase a 10 lease model or a 50 lease model versions. The only other input you need to put in are the historical payments. So you see there that on the time series, we said that we had historical payments up to June 2018. This lease started on the 1st of September 15. So the model is looking for historical payments in those financial years. Our first lease started September 15, so we need to provide an input for the 2016 financial year. That is a monthly payment, and it's a payment at the end of that financial year. So in this case, we're a June year end. So in June 2016, what was your monthly payment? In June 2017, what was your monthly payment? In June 2000, which means when you input this monthly payment, it is July 2018. So the time series said that the last historical month was up to June. We've inputted them in the historical payments tab. In the lease assumption tabs, this is now looking forward. What are your payments for July 2018? The model will then use the increases and the increased month to roll that out to the end of your lease. They're really all the payments that you need to actually, or the only inputs you need into the model. I would then recommend that you move across to the option analysis tab. And the option analysis tab provides you with an option or an analysis of the 3 transitional options. And it does this lease by lease. So you can see here that option 1 is as if the standard always applied, and it kicks off importantly on 1 July 18, which is the start of your actual period. Options 2 and 3 kick off at the start of the actual year, 1 July 19, so very different dates. Option 2 calculates the right of use asset as if the standard always applied, and the lease liability is the present value of the remaining lease payments. Option 3 calculates the lease liability as if the standard always applied, and the right of use asset feeds off that lease liability. What I did want to explain was just these items down here. So the operating lease accounts is effectively your straight lining accrual. So under the existing standard, if you have fixed increases or rent-free periods, etc., you needed to have a straight line. So the expense was different to your cash payments. So the model calculates this and eliminates it off your existing balance sheet. So for instance, under option 3, calculates the lease liability, eliminates your existing straight lining accrual, and balances up with the right of use asset. The other thing it does in this example is that I had a make good, and under the existing standard, you would have a separate make good asset. Under the new standard, the make good asset is included as part of the right of use asset. So the model eliminates your existing make good asset and calculates it as part of the right of use asset. And then the balancing item under option 1 and option 2 is a debit or a credit to opening retained earnings, either at the start of the actual year or at the start of the comparative year. Whereas under option 3, there's no retained earnings impact because you calculate the lease liability, you eliminate any accruals to items, and the balancing item goes to your right of use asset. What we have found is that some people may not have the same lease accrual from the existing standard as the model calculates, and that's fine. There may have been some different interpretations the way people have calculated that. Under option 1 and under option 2, if you have a different number in your straight lining accrual than what the model has calculated, you can just adjust that against retained earnings. Under option 3, if you have a different operating lease accrual number in your accounts as opposed to the model, you can adjust that against the right of use asset. The model then shows you year-end numbers. So it shows you 30 June 19 and 30 June 2020, and it shows you income statement, balance sheet, etc. and shows you how that's going to look under each of the options. So as I said, it does that lease by lease. You can then make an informed choice to decide, do I want to do option 1, 2, or 3? So you come back to the Lease Assumption tab. You can use this drop-down menu over here under the Consolidation options and decide, do I want to use option 1, 2, or 3? An important note here is that under the standard, if you choose option 1, you need to choose option 1 for every lease. And you'd need to go through option 1 for every lease. If you choose option 2, the standard allows you to choose between option 2 and 3 for every lease. So just make those decisions as you go along. The only other tabs you may need to use is then a consolidated lease tab. So I've only input 1 lease here, but if you had input 10 or 50, it will then consolidate it into here. And you can open up these boxes if you want down the left-hand side, and you'll see lease by lease. But if you close them up, it shows you the overall impact at the end of the financial years for 2019-2020, and it also shows you the transitional journals. So in this case, I've chosen option 2. So the journals are on 1 July 2019. If I went back here and chose option 1, you'll see that the journal entries move across to the start of that comparative year. If you want some more details to see how the calculations are driven, then you can move along to the Calculations tab. And you'll see that each lease is shown in the Calculations tab. And I can open up these columns down the left. It'll show me my payments, what the existing standard looks like, what the new standard looks like, and what it looks like under option 3, as well as my financial statement impacts. So here you've got the dates across the top. Transition period. So let's assume that you transitioned in June 2020. When it comes to June 2021, you now want to roll this forward. And that's when you move out of the transition model and you move into the calculator model. Very similar format, shows the terms and conditions, shows the user guide, establishes the time series. Now in this case, we're doing this for June 2021, which means my last historical month is presumably going to be June 2020, and I transitioned in the 2020 year. Once again, if you've got a December year end or you transition in a different period, you can put in those different dates and different historical months. What the model then does is it imports any of your transitional journal entries. So I only input 1 lease, but it's formalised through there to come through and grab those. You'll see there that it's doing 1 July 2019 because I chose option 2. If I had gone and chosen a different option under the transitional model, then it would move those journals across. So if I come across here, I have a look at my lease assumptions, I move this to say option 1, I go back here, you can see there that it's moved my transitional options, it's updated my lease analysis. And to do this, all you really need to do is to make sure that you edit the links. So once you buy the model, you save it into a certain directory in your operation, then if you need to update the links, just update it to whatever you've named that lease transitional model to. So you can save different versions of this Excel workbook just like anything else. You can name them differently. You can create multiple versions of it, etc. But just make sure that when you go to this Edit Links tab, that you have updated the right link to the right workbook. So it imports those. In the first year, when you're doing June 2021, there are no historical lease assumptions. So it's set up similar to the transitional model where you're going to operate off just the blue tabs. So operate off the blue tabs as the input tabs. And because it's imported all the historical lease assumptions from the transitional model, there's nothing required in the historical lease assumptions. But when you roll it over to 2022, 2023, etc., you will need to start to input some historical numbers. The pre-transitional leases come through. The most important things to note here is that it's been formalised except for a couple of items, and it's those three items. Now, this model assumes that you are now doing 2021 and that you have provided historical information up to June 2020. So probably the most important thing is that this per month payment here is for July 2020. Now, to get that, you can create a formula if you want. You need to go back into the lease transition tool, go across to the calculations tab, and to find July. Once you find July 2020, which is in that cell there, that is the monthly payments that you need to input into the calculator model. So if you had, for instance, market-based rent increases or you had CPI increases, this allows you to input whatever those new payments are at that time period. So you can either formalise the annual increase or you can change that depending on what happens, and also the borrowing rate. The other items all come through. You then can include new leases. So the 10 lease model enables you to transition 10 leases over, and it also enables you to add 10 new leases. So in this case, I've got a new lease starting on 1 July 2020, and I put in new data for that. Then I would advise you going over to the FS Journals tab. And we're looking here for June 2021. And so what it does is each lease comes through, shows you what the income statement balance sheet looks like, shows you what the journal entries are. The first 10 leases are your leases that you transitioned over. And if you keep scrolling down, at the bottom of the first 10 leases is where you then have new leases input. So you can see this is the new lease that we managed to input. It shows what the income statement and balance sheet is, and it also shows what the journal entries are for that. So you can look at them individually if that's how your model works, or you can look at these as consolidated FS journals. So consolidated FS journals will then show you what it looks like for all the transitioned and new leases that you bring through. So that concludes the demonstration of the two lease models that we have. I hope you find it of assistance in your organisation.